All right, so let's get this going. We are recording to the cloud, and let's see if we have any other more live options here. We do not have any other live options here. So we are going to get started today. Hello, my name is Hung Lu, and I am with Cash Property based out of Canada. So we are, oh my gosh, December the 13th. So we are very, very close to approaching Christmas time. So we are going to get started. So today, for the next 30 minutes, we are going to answer your questions around real estate, related to money, real estate. I'm also going to show you how to analyze a property when it comes to buying a business on the land with it. That's something that I've been doing lately, and so I thought it'd be good to share that with you from the point of analyzing it with a cap rate. So analyzing businesses plus land is slightly different than analyzing just like a multifamily, although there's quite a lot of similarity. So we'll get into that. So before we get into that, I just have to put out there a disclaimer. Okay, that before you implement any of the stuff that I talk about today, please go and just check with another investor, check with your lawyers, accountants, just make sure that it's a good fit for you. Okay, so we will do that. All right, so did that one, that slide. Okay, so, and we do have two questions to go through today. So yeah, if you've got any questions, feel free to email them to me, or put them in the Facebook chat and the live YouTube chat, and I will definitely get those questions and then attempt to answer them live on the call. Okay, so we've got those two questions. So I will answer those in a bit after the analysis. So let me bring up this sheet here, because I think this will show, this will help get the point across. Okay, so let me see here. So we're going to share screen here. You'll see my Excel sheet. Okay, so you should see my Excel sheet. So this is something that I've put together to try and help teach the concept of cap rates. Okay, so if you think of and your Uncle Vic, okay, so I talk about this Uncle Vic that I have, so VIC. So you can see it's written this way. So my Uncle Vic, this is an easy, quick way to calculate one of these three variables. Okay, so you're going to need your net operating income, the I, the C, which is your cap rate. So you need that where you're trying to calculate that. And the last thing is the value of the asset that you're buying. Okay, so Uncle Vic, and this is an easy way to do it. So if you are looking for the I, it's going to be your C times your V. If you're looking for your V, it's I divided by C. And if you're looking for C, it's I divided by V. Okay, so it's an easy visualization to help you remember this concept of Uncle Vic. Okay, so you'll need two of these numbers to be able to calculate the third. Okay, and if you don't have two of the three, you can sort of guess that number, or you can go and ask somebody else for that information, because it usually is available out there. Okay, so let's just say that I am looking at, this was for one of the businesses that I was looking at. And what I ended up doing was saying, okay, you know what, the business is generating about $545,000 a year in gross rental income. So you can use this for multifamily, you can use this for business plus land, or you can use this just for the business without the land. Okay, so I'm going to show you guys how that can go about taking place. Okay, so let's just say this gross rental income is 545. Now, it doesn't need to be rental income. It could be business income. Okay, so it's gross, meaning all of the sources of revenue from this business or from the multifamily. So that could include parking, laundry, if there's a store, storage, the water parks, so I've been looking at campgrounds recently. So the water parks, sale of wood, if there's a convenience store, all of that stuff would come in here, and that would be your gross income. Then the expenses. Okay, so this is how much your business or the multifamily is paying out every single year. And I put a note here, it's excluding, so excluding debt, because you want to run your numbers excluding debt, because my debt servicing may be different from yours. And so you want to get a true number, as close to true as you can get while you're doing the analysis here. So the interest charges are going to be different depending on who's buying it, what the qualifications are, what your down payment is, all of that stuff. So this number originally runs without your debt servicing. Okay. So here you can see the expenses in this example is about $511,000. So pretty much what's coming in is going right back out. So I already know that, 30,000 is not going to be a good number here. Okay, but let's just go through this exercise here. So we automatically calculate. Okay, so anything in the yellow is numbers that we put in. So the NOI is automatically calculated. I am putting in a 10% cap rate. Okay, so this number you can change. I use 10% because this was for a campground business that I was looking at. Campgrounds usually are between, on the low end is 8% and 10, maybe even 12% going up there, right? So I'm running it right now just at 10 just to see what the value is. Okay, so as you can see, the value right now is $341,000. Okay, so if the seller is selling their campground for around 340,000, then that makes sense based on the income and the revenue, sorry, the income and the expenses. Okay, so now this particular campground, they're asking for about 3.5. Okay, so that's the value that I'm putting in here. So what I'm trying to calculate now is saying, okay, well, what's my cap rate? Okay, so if they're asking 3.5, the NOI is the NOI, like that doesn't change. So it calculates for me the cap rate. Okay, and in this case, it's 1%. Okay, this means this is a crap deal. Okay, so at this point, you would just not continue the conversation here, right? Like you'd go on to your next deal. Okay, now the thing to keep in mind though is that the higher your cap rate is, right, the lower the value is going to be. The cap rate is one indication of, is one number that you should be looking at. It's an indication of how much risk there is. It's an indication of the value. It's an indication of the profit that you're going to make at the end. Okay, so it is a very good number to look at, but don't base your entire purchase based on that one number. Okay, so if you don't know the cap rate, right, you can go ask a mortgage agent, a real estate agent. You can ask other real estate investors. You could read this and get it from industry reports. So this number is out there. Okay, now this cap rate is different depending on what province you are, the type of building. So if you're buying, let's say, less than 5 units, okay, there's a certain cap rate for that. If you're buying between 5 to 10 to 12 units, that's a different cap rate. If you're buying, let's say, 15 to 40 units, that's a different cap rate. Okay, and then 40 plus units, that's a different cap rate too. So the type of asset affects the cap rate, the location, and even the location itself. There may be pockets within a bigger city that has slightly different cap rates. Okay, so keep all of that in mind. Okay, so then what I did with this particular example is I said, okay, well, let's take out the interest. Okay, so that's the interest that I would pay on any of the loans, so the debt servicing. Take out the taxes, so the corporate taxes. Okay, this is not the property taxes. Property taxes, the property taxes, like you're not going to be able to change that very much, right? So this is the corporate taxes that you'd be paying to CRA for the gains in the company. Okay, then there's depreciation and depreciation, and then what's the A? Oh, sorry, appreciation, depreciation, and then the D is the debts. Okay, so yeah, so that is interest, taxes, debt or depreciation, and then appreciation. Okay, so you want to make sure that you exclude all of that. So that is your EBITDA. Okay. Okay, so then you're going to calculate. So once I take that out, okay, that means that they're paying. So between the 511 and the 440, there's about $70,000 there that went to appreciation or depreciation costs or taxes or interest payments. Okay, so once you take out all of that, then your cap rate changes a little bit. See, so you see how, no, sorry, that one doesn't change. Yes, sorry, it does change because the NOI now is higher. Okay, so now we have a cap rate of 3. And the value of the building based on an NOI of $105,000 is 1 million. Okay, now if you think that this cap rate should be around 8%, let's go in here and change that to 8. You can see here that the value now has gone up. Okay, it is now, sorry, it would have gone down. Okay, so now it is 1.39. Okay, and you can see that because if I go back at 10%, it was 1.05. So as you can see, there's a direct relationship between cap rates and value. Okay, as one goes up, one always goes the opposite way. Okay, so it's an opposite relationship. Okay, so we're back at the 10%. So now the value of this asset is 1 million, but they're asking 3.5. Okay, so that's where there's that discrepancy. So now one additional way to run this is to say, okay, well, what's the normalized expense? So meaning you take out stuff that you don't really have to report or you may not need to report, or that it's slightly different for different operators. So one of the items would be salaries to the current owner, or if you're paying like some sort of wages or some sort of benefit to the owners, whether they work there or they don't work there. Okay, so in this case, there was some additional money that was in the books for the current owners. Okay, and you'll find this very common for owner-operated businesses. So in this case, now we've gone up to 176,000. So as you can see, there was about $70,000 of expenses that was in the books that, may not need to be there if I take this over. Okay. So now this is where I would put a word of caution here, because if the current owners are working in there and they're paying themselves 70,000, either I would have to go in there and work and pay myself that 70,000, or I would have to take that 70,000 and hire somebody to work there. Okay. There's obviously some service or some benefit that the owners were giving. Okay. Now, sometimes this service could be marketing, it's just an asset management fee. So maybe that is, what the 70,000 is. So you need to do that due diligence to figure out, okay, well, do I need to take that extra money and actually hire somebody to do it? Like, is the business self-sustaining enough? Okay. So, so yeah, I was goofing around with this with somebody else. So based on a 10% cap rate, we are now at 1.77 for the value of the building or this business. So as you can see, it's going up every single time we take the expenses out, right? Because there's more of an NOI. Okay. So now if we run it based on the 3.5 that they're asking, it's around a 5% cap rate. Okay. So it's still not a great thing, right? Because this cap rate is lower than the inflation rate. Okay. So you also want to, so as you can see, I went up from a 1% to 3% to about a 4.9% cap rate just by working with the expenses. So as you can see, if you have an asset, if you can decrease the expenses or increase the income, you improve your cap rate significantly. Okay. Okay. So another way to run this, especially when it's with a business, is to say, okay, well, what's the land value separate from the business value? So this would be useful if you are looking at just buying the business itself, but without the land. Okay, so there's lots of businesses out there that you would be able to acquire. You would pay the triple lease potentially to the landowner, and the land is not yours because you're just renting the space to operate your business. And then the landowner would increase rent on you over the time, and you'd have to pay a lease fee and then, run your business. Okay, so I myself don't like buying a business without the land. Okay. The part of the reason is because having the land is, think of the McDonald's strategy, right? McDonald's is not in the hamburger business. They're in real estate. Like that's where the chunk of their gain has been. Okay. Although, McDonald's makes a ton of money too. Okay. So in this case, what I'm looking for is always land plus the business. Okay. And ideally a business that I myself don't need to be in 24/7. Okay. Where I can do the marketing, I can do the business plan, I can oversee it, but I don't want to be there in the business. Okay. And so I would rather have the cash to pay somebody to work in the business. Okay. So in this case, what I'm doing is I'm just saying, hey, you know what? If I had to just buy the business, right? How much would the business be without the land? And if I'm looking at buying a business plus the land, then how much, is the land worth, so that I can get an idea of how much the business is worth by itself. In this particular case, it's a campground. So what I'm doing is actually saying, hey, you know what? There is a land value there, but because this is a business that needs the land value is already included. Okay. So this number here, this 600,000 should actually be zero. So that means that, okay, once it's normalized, the data is normalized, the business value plus the land is actually 1.77. It's not 2.34. Okay. That's in this case. Okay, this land value number is good if you're buying, let's say, a vacant piece of land and you want to build a business on it. So there's ways to consider this. So when you buy a multifamily, right, you're not buying the building without the land, like you're buying the land and the building, right? So when you're looking at multifamily, you don't want to consider the land value separately. You're just looking at the business value, which would include the land. Okay, I hope that makes sense. Okay. So that is the using the cap rates. So in this particular case, with this opportunity here, as I decrease the expenses, my cap rate's going to go up, okay, which is what I want. So the thing that I want to say about the cap rates here is that because the inflation rate is at 7%, let's say, or 6.5, depending on how you want to look at the inflation rate, you want your cap rate to be higher, okay, bigger, greater than the inflation rate. So, which is why, for looking at a business at 10% with a cap rate of 10% is a good idea because it's higher than the inflation rate. That means I'm going to have cash to debt service, right? My debts. Like I'm going to have influx of cash to pay for the debt servicing because the inflation is at 7%. Okay. If my cap rate is lower, that difference is coming out of my own pocket. It means it's a negative cash flowing property. So what you want to do is make sure that your cap rate is always bigger than whatever your inflation rate is. So if you anticipate that the inflation is going to come down, one of your strategies may be to, okay, well, acquire this opportunity at a lower cap rate because you know that the inflation rate is going to come down. Okay. And you just have to carry yourself for like that chunk of time, whether it's 1 year or 2 years, carry it in that negative cash flow until the inflation goes down. Okay. Not a strategy I would recommend because you really cannot anticipate those things. Okay, so I think that is all I want to say about cap rates and analyzing. So this would allow you to be able to analyze, an opportunity within 5 minutes, because if the cap rate is so outrageously different below the inflation rate, then you know that it's too much of a gap. to be able to narrow that down, right? Like it's going to be too much work to narrow that down. If you're at 5, okay, well then maybe, there's some additional revenue that you can generate or some additional expenses that you can shave off that will get you from 5 to 6, from 6 to 7, right? So that's where you need to decide, like, okay, what's my cutoff point? Okay, good. So that is the analysis sheet. All right. So let's go into, let me see here. Okay, so I have 2 questions here. Now I've lost those 2 questions here. All right, I got 2 questions. So before I get into the 2 questions, I just want to do a big shout out to one of my dear friends, Yelena, and also to one of my coworkers, Azariah. I pretty much live in my bubble here, like day in and day out. I am doing my real estate stuff, being a mom, and I don't pay a lot to the news. And recently I found out that, there's a war happening overseas, and my friends, Yelena and Azariah, you two are the 2 closest people that I know that are affected by this. And so I just want to do a big shout out to you, let you know that I'm thinking about you, and I'm hoping that your family is doing well, and that that everybody comes out of this safely. So sending lots of love and hugs to you guys. Okay. All right, switching gears, we're going to answer 2 questions. Okay. Okay, so this came through. All right, so Drew, this one is from you. So most of my tenants are paycheck to paycheck. So with the holidays here, so I'm changing some of the words to make them politically correct. Some of my tenants are late on rent. Do you have any suggestions? Okay, so I do have a couple of questions. So sorry, not questions, a couple of suggestions on how to deal with tenants. You know, a lot of my tenants that I deal with directly are in bigger cities. And so I cherry pick my tenants. And so they are usually employed. They have decent income. Now that doesn't exclude them from not budgeting properly. So this is across the board issue with potential tenants who don't budget properly or who put Christmas as a priority, or like buying gifts and buying, major big dinners at the holiday time, because that's more important to them, right? Than paying their rent on time. So the first thing I would do, which you had already hinted at, was that you are going to walk and knock on each person that is late on their rent, and basically talk to them and get the rent as soon as possible, right? So that's the first thing. And unfortunately, that really is the best thing to do, is to knock and just have that conversation with them and just tell them, hey, you know what, your rent needs to be paid no matter what. Okay. So now the second part of that, walking, knocking on the doors and talking to them, is making sure that you have your notice of eviction ready for unpaid rent. Now, of course, this depends on which province you're in, right? But the process usually is the same. If they don't pay their rent on time, you give them an initial notice of unpaid rent. Okay. Now, the one thing that I would also suggest is that in September, you start sending notices out, like just, some marketing blitz. And it's a great thing to have that communication with your tenants, right? Is to just say, hey, by the way, Chris, the holiday season is coming. If you need help with your budgeting, there's a local support group, and you provide that location, right? It doesn't matter what city you're in. There's always support groups to help families budget. Okay. And so a lot of times, there's that embarrassment there, around that, or they're not even thinking that far ahead. Okay. But that is one thing that you can do, is to give them that support that they need, so that they are able to budget and at least be aware that, hey, you know what, the holidays are coming, like they do every single year, and our rents are coming, which comes every single month, and we do have to make those payments. Okay. So that's one of the issues that I haven't had to deal with. So, but giving that notice and that support information may be very helpful for them. Okay. So the other thing that you could potentially look at is the families that have been with you, and this doesn't need to be done with families who've been with you a long time, or who have been delinquent often. But what you could suggest to them is set them up on a monthly prepayment plan for the year, so that by December comes, they've already paid their December rent. Okay, so what that means is you take their December rent and you split it over 11 months or 12 months, so that on the 12th in December, it's a smaller amount, right? So it's like a prorated rent program. So some families may like this because then it allows them to budget and say, okay, you know what, our rent is $1,000, so then a month we'll pay 1,000 plus an extra 100, and that 100 goes towards the December rent. Okay, the great thing for the landlord is now you've got the $100 in advance and you can do stuff with that. Okay, so you may want to offer a bit of a rent incentive discount to say, hey, if you go on this program, then we'll give you, like a $20 gift card or something like that. Okay, so it's up to you, like run the numbers to make sure that it works fine. So yeah, so the rent allocation prior to the year may be an option that they go for. Okay, this is not just an issue with paycheck to paycheck families or low income families. It's really a money issue. It's a mindset issue around what's my priorities and where am I going to spend my money. Okay, so as a landlord, you can help with that, or if you're a property manager, that rent program may be something that you can implement. Okay, second question here. Okay, so I do have a name for this person that came through. I think, was that Bradley? No, that was not Bradley. That was somebody else. Okay, so okay, so this person does not have a name. Okay, so we had a question that came through on our form. This one says, I'm a new mortgage agent, just completed my course in Toronto, Ontario, Canada. Okay, so yeah, so I'm looking at deals under 100,000 in Cleveland. Okay, so I was just like, okay, well, you can't do that in Toronto. There's no way. Okay, so I'm looking at deals under 100,000 in Cleveland area in order to get my foot in the door. Okay, so the first thing I would say is check out my YouTube video that I did with Mina and Tina. They are Canadian investors investing in the US. Okay, and I will put a link in the chats once I get there. So, okay, so I'm buying in the Cleveland area in order to get my foot in the door. Okay, if there are any lenders, okay, is there any lenders willing to do 85 to 90% LTV? I would say yes, there are. These are going to be at a higher rate, okay, because you're leveraging quite a bit. Okay, looking to rent out for income on a 30-year term. Aren't we all? Okay, so just to bring up this point here. So because you are a Canadian investing in the US, you are seen as a foreigner. Okay, just because we're north of the border and just because we can drive into the US, they still treat us as foreigners because we're not American. So I'm assuming that you're not American, that you don't have a US corporation. So that's the other thing. Make sure you check with a cross-border accountant and a cross-border lawyer, because you may want to set up an entity in the US and an entity in Canada, and then use the entity in Canada to buy in the US and vice versa, right? Okay, and you may also, this was a very good point that Mina and Tina brought up, was about if you're buying in the US, it may make sense to have an account in the US and keep all the money that you make in US dollars in the US, in US dollars. So you're not taking the exchange hit. when it comes back into Canada and when you go initially to buy, right? Just keep everything in the US, just open up a US account. Okay, so from what I understand with lending in the US, like there's companies like Lenda, so I'll put that in the chat as well. There's companies that will lend to you as a foreigner, but they will usually go up to about 70-75%. In very rare cases will they go up to 85-90%. That's too much leveraging for them. Okay. And your rates will also be higher. So it's not going to be, 3, 4, 5%. It's going to be closer to 7, maybe 8%, maybe even 9%, plus fees. Okay. So it's not just the interest rate. So yeah, so now you're maybe not even looking at B lenders. You may be looking at privates. So individuals who have cash that are willing to give you a private mortgage, okay, private lending on your property. And so that's easy enough to do because there's tons of private lenders out there, so you just find them. Okay. The other thing that I want to make sure that you are aware of is that some lenders, okay, will not, okay, lend on values under 100K. Okay, so it's a similar issue in Canada where people, there are lenders out there that will not lend on anything less than 150. Okay, I've had people say, Huong, we don't look at any files under 250. Okay, so I used to buy properties up in Thunder Bay, Ontario, and a lot of the lenders won't even do anything under 150K. Okay, so that's the other point to bring up. There are properties in Canada that you can buy for under $150,000. Okay, so if you're just getting into it, you may want to consider buying in those secondary or tertiary markets in Canada that allows you to buy under 100K or 150K. Okay, because even if you take the yeah, because if you take 200 Canadian and you convert that to US, then it's going to be a lower amount going to the US, right? So you may be able to push your dollar per door up. Okay, the other thing that I would suggest is potentially looking at partnering up with money partners and setting up a joint venture. It sounds like from this question, that you're just starting out in real estate. And so partnering up with somebody who has money or who can qualify for the mortgage may be your better bet in terms of getting into the real estate market. Okay, so just an idea there on that one. Okay, so that is the 2 questions that we had. So I'm going to say this again. If you would like to connect with me before the next live streaming, please use the QR code that's here and send me a message and book a time with me to chit chat. Happy to do so. You can check out and subscribe to our YouTube channel as well. All right. Thank you, everybody. If you have a deal you would like me to analyze in person, in live, like this, let me know. Just send it to me and I will definitely put it up and run through the analysis on it. All right. Thank you, everybody. Have an awesome day. See you next week.